Welcome to Assetization Radio, Episode 6, The Genius Act.
The way you handle your money, the way you pay for things, even the whole global financial system, it's all changing fast. Today, we're doing a deep dive into something right at the heart of this shift. The Genius Act. It's this really significant piece of U.S. legislation focused on stablecoins, those digital assets pegged to currencies like the dollar. Our goal here is to unpack the key bits from our sources, show you why this act is such a potential game changer, not just for stablecoins, but for real-world assets, even for giants like Visa and MasterCard. So maybe start us off. What's the absolute core purpose of this Genius Act?
Right. Well, the Genius Act, or S1582, it's really about bringing regulatory clarity. Critically, it states very clearly that payment stablecoins are not securities.
Okay, and that's a big deal.
Oh, absolutely. It's huge for mainstream adoption.
Right.
Look, this market's already massive, over $250 billion, so regulation was, frankly, overdue. But it's more than just domestic stability. There's a definite strategic angle here. It's seen as a way to really cement U.S. dollar dominance in the digital age. Yeah, Treasury Secretary Scott Bessent even projects the market could hit, $3.7 trillion. And he directly links that potential growth to this act passing, driving new demand for U.S. treasuries. The European Parliament actually has a term for this, crypto-mercantilism.
Crypto-mercantilism. Wow. Okay, that really paints a picture, sort of like using digital money as economic power.
Exactly, like a modern trade strategy almost.
So besides just saying not a security, what are the most impactful rules the act actually puts in place? What changes for how these things operate?
Well, several key things. It demands one-to-one reserves, and these have to be in highly liquid assets, think U.S. treasuries primarily. And crucially, issuers can't lend out or rehypothecate those reserves, so no funny business reusing the collateral.
Right. Keep the backing solid.
Precisely. Plus, regular audits, strong anti-money laundering AML compliance. They're essentially treated like financial institutions.
Yeah.
And importantly for users, it prioritizes stablecoin holders if an issuer goes bust. That's a big consumer protection piece.
Okay, prioritizing holders, that sounds positive. But, there are always potential downsides or things missed. Are there any catches here? Any unintended consequences people are flagging?
That's a fair question. Look, while it prioritizes holders, it's not FDIC-style deposit insurance. Your money isn't guaranteed by the government in the same way.
Oh, okay. Good distinction.
And the heavy reliance on U.S. treasuries for backing. Some worry that could actually introduce a new kind of systemic risk. Imagine a huge run on a major stablecoin.
It could ripple into the treasury market itself.
Potentially, yes.
Yeah.
It highlights the need for, careful coordination between different regulators.
Yeah.
This is definitely an initial framework. It'll likely evolve.
Right. Makes sense. So let's zoom out. How does this U.S. approach stack up globally? You mentioned crypto-mercantilism. Are other places reacting differently?
Oh, absolutely. The divergence is really stark. The U.S. is basically leaning into private dollar-backed stablecoins to extend the dollar's reach digitally. The EU, on the other hand, with its MiCAR regulations, is taking a much stricter, more bank-like approach. They seem wary of non-euro stablecoins gaining too much traction.
Trying to protect the euro's sovereignty.
Exactly. They're pushing their own digital euro, partly for that reason. It's a defense against, digital dollarization. Even places like South Korea are cautious. They worry that even one-peg stablecoins might, counterintuitively, end up increasing dollar usage if they're not careful.
Interesting dynamics.
It definitely creates a fragmented global picture. Makes things like cross-border payments potentially complex.
Okay, so bringing it back to the wider financial world, What does this clarity mean for other emerging areas, like real-world asset tokenization, RWAs?
Stablecoins are really the key infrastructure, the bridge for RWA tokenization. Well, tokenization is about turning physical things, real estate, gold, even treasury bonds themselves, into digital tokens on a blockchain. Stablecoins provide the stable digital currency needed to trade and settle these tokens efficiently. This could unlock huge benefits. Think of better liquidity for traditionally illiquid assets, fractional ownership becoming easier for smaller investors, and cutting costs by removing intermediaries.
And we're seeing this happen already.
Definitely. Tokenized U.S. Treasury debt alone shot past $3.9 billion this year. That's like a nearly 400% jump. It shows the immediate potential.
Wow. Okay, so that brings up the established players. With stablecoin transactions apparently booming, what about the traditional payment networks? Are Visa and MasterCard, in trouble?
It's the big question, isn't it? And the numbers are pretty staggering. Stablecoin transaction volumes reportedly overtook Visa and MasterCard's combined volume in 2024.
Combined? Really?
Yeah, growing at something like 300% a year. And you see big retailers, Walmart, Amazon, exploring stablecoins, likely to cut down on those transaction fees. There's a real fee compression pressure.
So should they be worried? Are they on the chopping block?
Well, not necessarily doomed. They're definitely not sitting still. They're adapting. Visa, for example, is already piloting using USDC, a major stablecoin, for cross-border settlements. They've settled over $225 million already.
Okay, so they're integrating, not just competing.
Exactly.
Yeah.
MasterCard's doing similar things,
Yeah.
building partnerships with firms like JP Morgan and OKX. And don't forget their existing strengths. Their massive networks.
Yeah.
Visa's got like 70 million merchants, the established trust. All the value adds like fraud prevention, dispute resolution. Those are powerful advantages, real moats.
So they're aiming to be part of the new system, not replaced by it.
Precisely. They're positioning themselves more as orchestrators of value flow, whatever the underlying currency, dollar, stablecoin, maybe even CBDC happens to be.
Oh, okay, that makes a lot of sense. So as we wrap up this deep dive then, what's the bottom line? What does the Genius Act really signify for you listening?
Look, the Genius Act isn't just another piece of regulation. It feels more like a catalyst. It's accelerating this move towards a sort of hybrid financial system. It means the ways we move money, the things we consider assets, how we interact with finance, it's all fundamentally shifting. The lines between traditional finance and digital assets are getting blurrier. Ultimately, it points towards financial tools becoming, hopefully, more efficient, maybe more transparent, and potentially more accessible globally.
Right, and maybe here's a final thought for you to mull over as you go about your day. With things like regulated stablecoins and tokenized assets becoming more woven into the financial fabric, how might these new digital tools actually change the way you save or invest or even just spend your money in the coming years? Something to think about.
Good morning, and in case we don't see ya, good afternoon, good evening, and good night.